Hey Bulls and Bears, it's Saturday and welcome to Bull, Boom, Bear, Bust. Alright, that's way too corny. I'm not going to keep that. I know a couple of you got a laugh out of that. But seriously, let's talk about the debt tsunami, the bankruptcy avalanche that I believe is headed towards millions of Americans here in the United States very, very soon. Let's talk about the enormous levels of debt that people are under and the dangers when you combine that with rising interest rates. And these credit cards are going to skyrocket. The debt's going to explode even faster with the higher rates, combined with this high cost of living. Let's take a look right here to begin. And let's start right here with a little bit of a flashback to the beginning of May, so only about a month and a half ago. Consumer credit card debt and annual percentage rates are heading to all-time highs. Well, a lot can change in just a couple months, less than 2 months. Take a look. We have now breached that all-time high level. And here we are. Credit card debt in the U.S. hits all-time high of $930 billion. Now, by comparison, Americans were only at about $870 billion at the peak of the financial crisis, or at the peak of the market in 2008, before the housing market took down the rest of the economy. But then we hit new all-time highs right before the pandemic. The pandemic hit, people were able to pay down their credit cards because so many businesses were shut down. People didn't travel. People got extra payments in the form of stimmies that were sent out to millions of people. People got to miss out on their rent payments or skip out on their mortgages or both. And credit card debt actually went down in 2020. But here we are now, less than 2 years later, or just over 2 years since the onset of the health crisis, and we're back again at all-time highs, as we told you would happen. Before this, we already witnessed other areas of debt already at all-time high territory: housing, student loan debt, auto loan debt, car loans. Now let's take a look at some of the other data here. Credit card delinquency rates increased 0.16% from the prior quarter to 5.32%. So a little over 5%, meaning about 1 out of every 20 people are delinquent on their credit card payment. Also, younger Americans 18 to 29 years old have a 76% higher delinquency rate than anyone else. And we know that younger people in this country have a very difficult time. By the time you get out of school, even college with a college degree, you're usually strapped up with a lot of debt, a lot of it's student loan debt, but just even credit card debt. And then you look at the cost of homes, the cost of everything else, the cost of an automobile now. It's outrageous. So the younger people are hurting the worst. And these are also the people that don't have anything to their name in most cases. When you compare that to somebody in their 40s, 50s, and 60s that may have bought a home back when things were cheap, and they have a lot of equity now. But it's not just the young people. We have the retirees returning to work. We have a big surge in people that thought they could retire, and now with the cost of everything, they have to go back to work either full-time or part-time, or they have to do a side hustle. Maybe get a job in the gig economy, driving Uber or Lyft. And when you're in your 60s or 70s and unretiring, those are probably not the most pleasant jobs to have to take, is delivering food to somebody. Especially with the cost of fuel. It's everywhere you look, it's pain and struggle for so many people. Now, as far as this credit card debt, think about this rising rate environment, the all-time high levels of debt together. That is a lethal combination, and that's why I continue to say and predict that we're likely going to see some sort of massive bankruptcy wave closer to the end of this year, if I had to guess. But it's not just a guess. It's not just flipping a coin. We look at all the numbers, the data, and this is not going to be easy for people, especially when there's really no sign of any price corrections. Yes, the housing market's starting to come down a little bit, but take a look at how much higher the housing debt is compared to before the housing bubble went bust in 2008. Now let's take a look at a chart here out of Visual Capitalist, and we see the previous peak right before the housing bubble went bust and where we are today. Now this shows the total of 15.6 trillion, but that was the end of the fourth quarter of 2021. I still wanted to show you this chart, but actually today we are past $16 trillion total consumer debt. That's not government debt, that's consumer debt. That buried under this massive amount of debt. So how can you take a look at this chart and say that we don't have any trouble when back during what we call the financial crisis, here was the debt, and here we are today, way beyond where we were back then. Now, many people are out there saying we're going to see a housing market correction. Some people even say it's going to be a crash. I don't see a crash, but we are starting to see asking prices come down. Some cities are seeing year-over-year price declines. Examples would be Chicago. So if you want to get good deals on real estate, you're going to need to keep yourself from getting your credit all dinged up. If you have cash, of course, you're going to be in the best position. Will most people be able to buy homes with cash even when home prices come down or correct? Probably not. So what you're going to want to do is keep your credit in as good of condition as you can be. Keep your credit score up there, because even with cash, home prices aren't going to come down so much where most people will be able to pay for it in cash. In fact, with these levels of debt and the rising interest rates, most people are going to be in big trouble. Their credit scores are going to tank. They're going to have defaults, bankruptcies, and you're going to see big problems with people trying to get a mortgage. So in my opinion, it's going to be mostly cash buyers in the real estate market when prices finally do correct. Because with so many people in debt right now, remember, 7 out of 10 people that you see right now in America are in all-time high levels of debt. 7 out of 10 people are in all-time high levels of debt. If you're one of the people that's out of debt completely, then you are, and if you're actually debt-free, you're actually in about the 10% category from the research that I've done. Less than 10% of people are completely debt-free. It's a very rare thing now, and it's going to become more rare as we progress into this environment where the cost of living continues to go up, combined with these rising rates. I would recommend everybody, I shouldn't say recommend, I would urge anyone to consider being careful about where you spend your money. Try to put cash away. Cash is still king. Yeah, the dollar's losing value, but it's not going to go away anytime soon. Because what's the alternative? A bunch of other fiat currencies that they're creating into thin air in infinite amounts. All right, so continue to hold cash, but yes, also brace for rising prices. Try to keep your credit clean for buying opportunities. If you're a cash buyer, you're going to be in the best position for what's coming down the road. Other people still disagree. Other people say spend your money now, because everything that you're going to buy today, if you don't buy it now, it's going to be more expensive next week, next year. So some people are under the impression that prices are going to continue to go up and no corrections, not even real estate. I think we're going to see some corrections in some places. Real estate, yes, not a crash. But in other places, you're going to see continuing rising prices. Hopefully not hyperinflation, but we'll have to see how this goes, folks. Thanks for watching this report. Be well, stay safe, keep stacking. Bye for now. Peace.